Hello and welcome to this very special interview on Money Paathshaala. Today, I have, after a while, got the chance to interview a very, very old friend. Uh, he started his professional journey in managing the stock market around the time when I started my journey as a journalist, and it's been that long an association. Navneet Munot, one of India's most respected mutual fund professionals, started way back in 1994, has had multiple roles, and is today the managing director and CEO at HDFC Mutual Fund, which, of course, knows no introduction, one of India's most respected mutual funds and leading mutual fund houses. Thank you very much, Navneet. It's always been a pleasure talking to you, so I see today as no different. It's good to see you in your new role. It's good to see that you've started speaking again. We've missed you a lot on, while you were getting settled into your new role. My first question, I know we are recording this today where we are still above 66,000 on the Sensex. How do you see this, the sudden journey, the sudden spurt? Of course, there's been a mild correction as well, but still above 66, especially in certain pockets of the market. Perhaps the rise has been even more spectacular. Uh, how do you read this move, and what is your word of caution to investors who would probably see this as yet again, okay, let me come and try and trade this market or come and invest for the short term?
So thank you, Vivek, for having me, and it's such a pleasure to talk to you. It's always a joy having a conversation with you, so I'm equally excited. And you are right, markets have risen sharply. I think we have seen a big rally even in mid and small caps over the last couple of months. Till a few months back, investors were concerned about various things: high inflation, rising interest rates, geopolitical risk, El Nino, which can impact food prices, and whatnot. While some of the risks haven't played out as envisaged, and also given the structural story of India and the attractiveness of India relative to most of the other economies, we have seen huge FPI flows in last few months. So, as you rightly said, that prices have increased, but so are earnings. I mean, if you have been looking at the corporate results, by and large, they have been decent. Financials in particular have done very, very well. So, with prices going up, valuations have gone up, and investors should not extrapolate the recent returns. The kind of rally you have seen in last 2 or 3 months may not happen every quarter. But at the same time, I will hasten to add that investors need to focus more on the long-term prospects of India, long-term prospects of growth story of India, and not get swayed away by the short-term market movements. One can always use the power of SIP and STP to keep investing in the market without going all in at once if they are worried. But the idea is to be in a market. I mean, I know this is a cliche that it's the time in the market, not the timing the market, which is more important. Let me give you an example to put this in perspective. So our HDFC FlexiCap fund has been around for 27, 28 years. Had someone invest, and we looked at if somebody invested at various peaks in the market, the peak NAV, let's say February 2000, if you remember, when the Sensex peaked at 6,000, and then did not go up for next several years. I mean, the market did not deliver good returns for next several years. Even today, they would have made a return of around 18% CAGR. I'm not extrapolating that you will get those returns. Maybe that era was different. But even if you invested at the peak and market did not deliver returns for next 3 years, today, if you have held on to it, you have done well. If somebody did in 2008, the another a peak of the market, and then market did not do well, they still make over 12% CAGR. Or a very recent case, if we take, if somebody invested in February 2020, just before the crash due to COVID, they've also made around 20% CAGR in the fund. And of course, if somebody has done an SIP over a long period of time, the overall experience would have been very, very good. So markets will make new peaks. We are in India where economy will reach a new peak, corporate profits will reach a new peak every few years. investors need to hold on to that. And I mean, the point I was trying to make with those examples is that if you get very unlucky with timing the market, you still made decent returns. But if you stuck to the discipline of SIP, you made great returns. And you need to have this faith that a $3.5 trillion economy will go to 5, 7, 10, 15, and by 2047, we would be a 20, $25 trillion economy. Market capitalization will grow. So I think thinking long term is the best approach.
In fact, Navneet, it's very interesting that you brought up this example. I feel that people of our generation, you talked about 27 years ago, I would be very surprised that out of the total pool of investors that you got into this scheme, how many actually stayed those 27 years? I think it would be a very, very small number. And that really brings me to the point that, 18% CAGR, and of course, nobody is saying that in the future it will be 18, it could be more, it could be less, nobody can predict that. But look at the wealth opportunity and the way you talked about there is still a lot more for India to grow. We've not come that far as much as we have further ahead of us.
So
Do
we
you
say
think?
this that this kind of wealth creation that has happened, one needs to keep a simple formula in mind that wealth creation equal to sound investment plus time plus patience. And if
Hmm.
you want to remember this formula, remember the acronym STP. Sound investment plus time plus patience equal to wealth creation. There is no other formula. Vivek, I mean, you have been watching markets, you have been a huge expert on investor behavior over the long run. I don't think we can summarize this better than that.
Do you, Navneet, if you were to, speak, and you are probably speaking to a 25-year-old right now, what would be your advice that, people 27 years ago, probably didn't understand, that much about mutual funds. The mutual fund industry was a fraction of what it is today. Hardly any digital ecosystem in place. But today's 25-year-old has all those opportunities. Uh,
Absolutely.
and what would be your advice to them who probably have not invested but should invest? What would be a starting point for them, according to
No, I think one of the starting point is that starting early is very, very critical. You start investing at the age of 25 versus starting at the age of 35. When you retire at the age of 60 or whatever, that makes tremendous difference. Those 10 years make a lot of difference. And even a small amount, if you make a beginning and keep that discipline, I think that is very, very critical. So start early, invest regularly. I think that is one of the key advice I would give to any youngster today, and that's very critical. Now, talking about the youngsters, I mean, they are of course a lot more smarter generation than us. I always believed, I mean, every generation is smarter than the previous one, and today's one are also privileged in terms of the access to information they have, access to knowledge that they have at their fingertips. At the same time, you also have a generation which believes in zindagi na milegi dobara. So your income, I mean, how much you can kind of like spend. Somebody the other day was giving me a data point that almost, I don't know whether that's correct, but somebody gave me this data point. I need to check that one out of five personal loans taken these days are for travel. I mean, of course, you should experience life, but at the same time, your spending has to be income minus savings equal to spending, not the other way around. Income
you?
minus spending equal to savings. You need to make certain life goals and then work backwards how much money you will need. And that long-term power of compounding makes a lot of difference. Give you one example because you talked about the youngster. Buffett says that he got very lucky that he started at the age of 11. And he had that dream of becoming a millionaire. I think he became a millionaire in probably late 20s or sometime in 30s. But 99, somebody who started investing in such a disciplined manner at the age of 11, but today he says that 99% of his wealth has been created after he turned 50. It takes a long time for that power of compounding to really play its role. And that's one of the most important things the youngsters need to keep in mind. And they have a big advantage over others who miss that. It's some of us, maybe technology wasn't there, maybe that kind of track record wasn't there, maybe that kind of awareness wasn't there. But today, everything is at your disposal. So one should make the best of it.
Navneet, since we are speaking, I think probably post or during the whole COVID phase, when a lot of young people entered the market. Some, opened demat accounts, started trading. Many opened folios and started investing in mutual funds. And we've seen all those data points. But have you seen a change in investor behavior in terms of, where earlier, or we saw that even during the COVID meltdown of the market, where the extreme fear came in, or the extreme greed, and this whole timing thing. Are you seeing a difference in behavior where people are willing to show that STP that you talked of, the discipline, the time? Are you seeing that?
No, no, absolutely. I think this is one of the most heartening feature about our industry. Maybe a couple of things that have worked in the favor that thanks to the long-term track record, you have funds going back 20 year, 25 year, almost 30 years now, delivering those returns despite so much of volatility, so much of ups and downs in terms of economic cycle, business cycle, profit cycle, political cycle. Globally, so many things would have changed, but these funds have compounded money so much over a period of time. The level of transparency, I think we are a hyper regulated industry. And even as an industry, I think the kind of transparency that we have that has clearly got more trust of the investors. Technology, you rightly touched upon that it has made investing very easy, very seamless, a very good experience now. And last but not the least, I think the whole investor education campaign and the role that people like you have made in terms of guiding the investors in the right direction, that what is the best way of creating wealth for you. The SIP flows continuing and increasing every month is a very, very heartening feature of the industry. And again, I mean, compliments to people like you who have played a very big role through your writings, through your these videos, through various means. I think industry has also done a good job, and of course, regulators have played a big role in nudging us towards more and more efforts on investor education.
Navneet, some of the data that is coming out of AMFI indicates that in the last 6 months or so, we've started seeing a lot of folios, retail investor money coming into small caps or mid caps. So again, that's a heartening thing that people are, trying to enter a company at a smaller stage, but probably many don't understand the risk. One of your peers told me the other day that, it's almost euphoric in certain of these small and micro cap kind of companies, and investors should be cautious. What is your own reading of, the whole small cap, mid cap universe, which doesn't get covered within the headline Sensex or Nifty numbers?
First of all, I mean, small cap funds are not a narrow theme. I think the universe of stocks is very large within small caps. As you know, the top 100 stocks form the large cap, the next 150 are the mid caps, and everything else is a small cap. So that way, there is a large universe to choose from for a fund managers. You are absolutely right. The small cap funds have outperformed recently, and more money has come into the small cap funds. But there have been like long periods where the segment did not get as much money. I'll use an example from a different context here. Around 2 years, yeah, exactly around 2 years back, a lot of money was going into the IT and digital funds because investors were seeing that over 6 months or 1 year period, those funds had done better than other categories. So trying to chase a category for a short-term performance is not the right approach. Each investor has a different investment objective, different time horizon, different risk appetite, different liquidity needs, and what is suitable to you. Accordingly, one should allocate your fund rather than chasing the category based on the recent short-term performance spike. So answer your question from a broader perspective, we have seen investors chasing certain categories like sector funds or at some point in time international funds, among others. We keep repeating the line: past performance is not a guarantee of future performance. What you need to see are more longer term returns and specifically your investment profile. So small cap is a good category. You have a large universe. India is an emerging economy where large number of sectors which are getting listed at an early stage of growth will continue to do well. Several of these companies over a period of time transform from a small company to a mid-sized company to a large cap company. Today's large cap were yesterday's mid cap and the small cap of day before tomorrow. But at the same time, one should not chase just because these funds have done well in last few months. One need to allocate properly.
Navneet, a question I've always wanted to ask you but couldn't because you were always an active fund manager. Now that you are the managing director and CEO and you have both active and passive funds and schemes under you, there is this debate for a long time on passive versus active. Now it looks like passives are getting popular in India as well. What is your own view? Who should look at an active fund? Who should look at a passive fund? If you could outline this for our viewers.
So while passive is a more recent trend, active funds have a long track record, but even some of our at HDFC, I think our index, I mean, some of the index funds are also go back, almost 20 years. But the flows into the passive funds have been a more recent trend. I have a firm opinion that in India, both active and passive will continue to grow. It won't be one at the cost of the other. For passive to grow, active doesn't have to grow less or degrow like some of the other markets in the world. There has been a phenomenal rise, as I said, in the passive funds growth, but we have to take this view that Indian households are massively underinvested in equities. And there are many ways you can meet the market. One of them is passive fund, one of them is an active fund. Uh, I think active funds will continue to be a very, very large part of the market, but because passive funds are starting from a lower base in terms of AUM, so AUM growth as a percentage could be higher. Uh, we are a big believer in active management. In our opinion, India has a material alpha to offer. You look at our funds like HDFC Top 100 or Flexi Cap or ELSS or Balance Advantage. We go back like 20, 25 years, and there is long, history of delivering alpha. Wherever there is a rally which is very narrow, there were 2 or 3 years where we saw that only 5, 7 stocks in Nifty were responsible for the entire Nifty return. There was a period where some of these funds didn't deliver good alpha, but as the rally becomes more broad based, and I think India is in its growth period, supported by various sectors and various themes and various segments, good returns are likely on the if you do the right stock selection on the active side as well. Now, I mean, we have both. So because you told me about the as an MD and CEO, I think we have 25 plus passive products to help investors participate in the market because we want to be a one-stop shop to our investors. So we have both active as well as passive to choose from.
But for a beginner, do you say that get started, wet your feet with a passive fund, say a Nifty or a Sensex or whatever?
I mean, if you are like before you decide which fund that you want to buy, either a plain vanilla large cap fund, or if you want to maybe start your journey with an index fund also, maybe you can just invest in a Nifty or Sensex index fund.
As always, a pleasure talking to you, Navneet. Thank you so much for taking time out of your busy schedule and speaking
Thank
to
you.
investors. I look forward to many more conversations with you. Thank you so much.
Thank you. Always a pleasure.